So far, 2016 has been a rough year for global markets, leaving many investors wondering, where's the growth? Maria sat down for an exclusive interview with JPMorgan CEO Dimon to discuss his take on the global economy and his top priorities heading into this new year.
Let me move on to investing and where you see the best opportunities around the world right now. What is JPMorgan allocating capital and where? I mean, you look at what's going on in Europe right now and in Asia. We know this China story, but are there areas right now where you believe are investment opportunities?
Yeah. So, think of what we do is we constantly segmenting, deeper and deeper segmenting everywhere. So in the United States, we've set up more segments in middle market lending. In small business, we set up more segments. Then we go deeper. So we can do it geographically, we do it by product, we do it by region, we do it by country. So we look at countries and say how many our clients set in a country is multinationals. Local multinationals going into the country, multinationals going out of the country. And how can we capture those flows? And we built to capture them. And we're still doing that all around the world. In investment banking, we're doing that by saying, why are we not stronger in this industry or that industry or this industry in that country? Do we have the right bankers in the right place, et cetera? And if we don't, we try to go higher or train people.
Is there an area of the world right now that you see particularly attractive?
Yeah, I mean, in China, we're still, our view in China is that 20 or 30 years from now, the likely outcome is that they will house, 30% of the global Fortune 2000. And they have a lot of growth to go. It may be rocky times in the meantime, but the big difference is that's still the likely outcome. So we want to manage the turbulence, but make sure we invest properly. We were at a risk committee meeting, I think it was in India, and people were talking about the risk and the corruption and the problems and the low growth. And there's a year or two ago, I said, if you were having a risk committee meeting about America in 1870, you would have said the same thing. It just had a civil war, it had a racial problem, it's had tons of corruption, it's polluted, and people were shipping money to the United States to industrialize it. And it was coming from Europe, okay? And so you got to keep your eye on the long ball, too. We are in the stock market. And then when we're there for people, for your company, we're there for good. We're working for good with them. We want to do it everywhere. As you grow, and we serve you in different countries. And so that's kind of our view. And then we manage through the weeks and the months and the years.
By the way, we all know that the diversity and the strength and the size of JPMorgan is the reason that JPM was able to bail out the government, frankly, during 2008 and by acquiring Bear Stearns, Washington Mutual, and being there. But we also know that broken up, the parts could be valued higher for shareholders than as a whole. This question keeps coming up about the banks breaking up.
Actually, the guy who wrote that report, also from Goldman Sachs, by the way, very good analyst, went to our investor day last year, and after that investor day, because it's not true. Okay,
you don't think that the parts are worth more?
Absolutely not. And you just said, by the diversity, the stability, the ability to invest, that was because of part of our diversity, our huge size and strength, so we can serve huge countries around the world. We can invest more overseas because we're big in America. We can take, intelligent, thoughtful risks somewhere because we can afford to do that, where you can't if you're smaller. And it was a lot of the undiversified companies that failed, by the way. So always keep that in mind. So, but anyway, the analyst wrote a report, and I think he said, after that, case closed. He looked at what we said. He looked at the expenses, the synergies, the duplication we had to go through, how it hurt our clients, stuff like that. And he said, case closed. So I don't think it's a really legitimate argument. I'm sure people continue to make it. It's just fun to make.
All right. The priorities in terms of spending, investing from JPMorgan. I know you're spending on cybersecurity. I know regulation is a priority. What are the priorities in 2016? Well,
so regulation is sine qua non. And that's billions and billions of dollars. We simply have to do that. We're doing that. We have to embed it in all of our systems. We have to meet all the new requirements, and we're going to do that. But we said, what are the big new ones? Big data is real. Okay, it is real. The importance is real. We're embedding it across our company. We have a lot of data scientists and PhDs in math and physics, et cetera. Cyber is real. We're spending almost $600 million a year now. I'm sure it's going to go up. We're very strong. We have very good cyber defenses. If you ask the government, they say banks and defense companies are probably way ahead of most other people. And digital, which is also real. Now, digital is in a long line of technology. It's not brand new. I mean, Wall Street's been digitizing. Banks have been digitized for years. And if you go back to even when I was a kid, people settled stock certificates physically, and then they put it in a vault, and then they had one vault, and they digitized the vault, and the cost of doing business was coming down like this. And so, but putting it on mobile, making it easier for people, giving them service they want, reducing the pain points, having it online applications, all those things would be great. And we're going to do all of them.
John, Dimon just said about China, even with all the growing pains, it will be home to 30% of global fortune 2000 in the next 30 years.